I'm Donald Leggett, and welcome to Share Views, brought to you by London South East. Our guests today are Sachin and Stephen Williams, co-chief executives at Reabold Resources, who've just raised £6 million and also announced an investment in Danube Petroleum. Welcome, gentlemen.
Thank you.
Okay, let me start by Sachin. Could you sum up the Reabold strategy for me? It's a little bit different from the norm.
Yes, absolutely. Reabold's strategy is to invest in high-quality, pre-cash flow, upstream oil and gas projects where the capital we provide can get the project moving forward very quickly and has a high impact to the Reabold shareholders in the case of success. When we think about high quality, we mean projects that are able to generate returns at very low oil prices, but we are not necessarily sensitive to the oil price at all. We also have to have these projects be able to have a clear pathway to exit and monetization such that the shareholders can benefit from these high impact returns in a very planned way. Our initial focus for the investments we're making are Europe because it happens to be a hotbed of opportunities for those types of projects where our capital of approximately £1.5 million each can get those projects moving in the time frame that I described.
And those are unlisted projects, are they?
They are. So the projects we're investing in have been in private companies that are the operator of the upstream oil and gas projects that I was referring to. You've
just raised £6 million. So who did you raise that £6 million from? Let's ask you, Stephen.
Yeah, it was a combination of institutional investors and some retail interest as well. We were extremely delighted with the quality of the register we got, which I think is fairly unusual for a company of the size that we are as we start out. I think there was probably some recognition of the expertise that we bring to this space from our time as professional investors across the energy spectrum, and also just some excitement about the fact that we're doing things a little bit differently than a typical junior oil and gas company.
So you're quite keen to see private retail investors getting in there as well?
Absolutely. I mean, we think this is suitable for institutions, for retail investors, and ultimately we want to generate a return for all of our investors.
So what's the investment case for the private retail investor? Why should they invest with you chaps?
Well, as I just touched on, I mean, we do things a little bit differently than a typical oil and gas company, and that really does stem from our background as investors in the space. And we spent several years really getting frustrated that even when we found a company that had great assets and seemed to be able to take those assets forward to a certain extent, it didn't seem to translate into positive shareholder returns. And we saw companies with good assets with consistently falling share prices, and obviously as an investor that's extremely frustrating. So everything that we do, from our top level strategy right through to the way we operate the business, is designed to ensure that the good quality assets that we are confident that we are getting exposure to will translate into shareholder returns.
I'm sure the private retail investors are very familiar with good asset-backed companies with a falling share price.
Absolutely, and we think we can change that. I think it's also worth saying that the timing is ideal right now to be deploying capital into these high-quality upstream projects. So being counter-cyclical is everything in the oil business. History shows that you make money in the oil and gas space when you invest capital when costs are low. Not necessarily when the oil price is high, but when costs are low. Costs are extremely low at the moment, both in terms of the price that we can access the asset for, and more importantly, the capital required to take the asset forward.
And Sachin, what are those unlisted opportunities that you're looking for? I know that you put money into the Parta field, you put money into the Colter field. What else? What are the typical things that you're looking at the moment?
Yeah, so those are two very good examples, hopefully, of the strategy that highlighted and exemplified what Stephen had said. But the first element about this is the technical risk of the projects we're looking at are relatively low. Mm-hmm. These are in the appraisal phase of the life cycle at the earliest for the investment projects. And what we find is the ability to buy relatively low pre-cash flow assets and relatively low technical risk means that the cash to actually acquire the project is low, and on top of that the capital we're providing is to actually begin the drilling campaigns for those areas, and then because the costs are so low as Stephen had described, it means that we're actually able to get after this stuff at very low cost in the ground as well as the acquisition cost. So
why would you say it's possible to buy these at fairly low cost? What are the dynamics around that?
Yeah, so the key dynamic here is how the market is viewing pre-cash flow assets. And pre-cash flow assets in all its phases, whether they're good quality or poor quality assets, have been starved of capital by the industry because of where we've been in the cycle. And that has meant that all assets, good and bad, have been treated as though they have no value when they're in the pre-cash flow phase. That's the element of the cycle we're in right now. So identifying the good quality ones means that you have a chance of creating value because you can buy in so very cheaply right now.
So you think you're in an investment sweet spot at the moment?
Absolutely, and it's worth noting as well that we've been assessing these assets for a number of years in previous guises. We have the advantage now that we as a company are not burdened by legacy assets that maybe we picked up at the wrong time of the cycle that are not so high quality, and we have the ability now to go and cherry pick the best quality assets that are available in the market, and there is an abundance of good opportunities out there.
So what sort of time frame are you looking to make a return on, and what are your potential exits?
Well, the key for us is that we are investing capital that goes into drilling as quickly as feasible, really. So already in the few weeks that we've been in place now, we've got Reabold access to, hopefully, if everything comes together, 4 drilling events in 2018. So that's the sort of time frame we're talking about. And because these assets are already quite progressed, we're talking about wells that will themselves be clear catalysts of value creation. So we're not talking about the first well in a basin which inevitably needs another 5 wells to actually prove up the resource. We're talking about the first well in each case being something that will crystallise that value.
Very interesting. Today's announcement was about £1.5 million that you've invested in Danube Petroleum, who own half the Parta gas field in Romania. So what do you actually get for that money? And is it good value for money?
We believe it's fantastic value for money. We get 29% of Danube Petroleum, but the key thing again is that the money that we're putting in is money that's going to go into the ground. That is the money that will fund the drilling of the first well around about the middle of next year. And Sachin already talked about how these projects are relatively de-risked. So we're getting exploration type pricing for what are very much appraisal, or even better than that really, opportunities. So within the Parta license, the Parta appraisal program is essentially re-drilling 2 1980s gas discoveries. Gas has flowed from these fields before, so we know it's there. So this is very low risk from a technical perspective.
Okay, so that's Parta. What about summing up the Corallian project for me, please?
It's a similar situation. So it's an oil field that's had 4 wells drilled into it. Oil has been seen in this field, and again, this was done quite a few years ago. Circumstances have changed since then. 3D seismic over the prospect has de-risked has de-risked the asset and optimised the drilling location. So again, it's a relatively progressed asset that already has a lot of information associated with it.
You know what you're getting yourself into.
Absolutely.
Very good. Reabold is AIM listed. So what's your ticker symbol and what's the market cap currently? That's Sachin, that one.
Yeah, so the ticker is RBD.L and the market cap's approximately £10 million. It's been moving around a little bit today, but as we sit here today, it was approximately 10 million.
Well, there was a lot of Twitter activity today. Do you find in your experience that Twitter activity leads to those people becoming investors, or is it just what it is, a little bit of noise?
I think Twitter is a great social platform for communication amongst investors and potential investors, and we're always interested in what our investors have to say and what they're thinking about. So it's useful from that perspective, and hopefully, as I say, a forum that they can share their own thoughts about the company, and indeed gives us a chance to know what we need to address when we're communicating things about the Reabold strategy.
What's the difference between your strategy and a farm-in, and why do you think that your strategy is the way to go?
It's a very pertinent question, particularly given the 2 transactions that we've just made. What we've done is we have chosen to make investments in companies. The way that we manage the project, the exposure that the shareholders have, and our control associated with those projects are through the subscription agreements and the shareholder agreements. And it is our belief that we are able to exert more control that matters to us through the shareholder agreement and provide more protection to the Reabold shareholder than if we were to go onto the JOA of a typical, operating entity. And for those 2 reasons, or 3 reasons really, we think we can actually do things differently. Now, what that does mean is we have to craft each agreement on a case-by-case basis in order to achieve everything I've described. But it requires the two of us to sit down and think about that very carefully, because we have seen many small companies fall foul of being on the JOA agreement.
By which you mean if you're the smaller fish in the bigger pond, you tend to get it ignored a little bit?
It's worse than being ignored in many cases. It is more a case of if you are the smaller player and your bigger parties start outspending you, you can get kicked off the license entirely. So all the money that has been spent, all the work that's been done will result in the small player having to relinquish their rights on the license completely. A shareholder agreement offers protection in the form that yes, you can be diluted by raising of money, but you can never be kicked off if you are not putting in money at a capital raise of the operating company.
So what would your biggest worry be? Maybe this is one for Stephen. What would your biggest worry be? What's keeping you awake at night in terms of these investments?
I think the biggest worry relates exactly to what Sachin was just talking about, which is just making sure that we get the project to progress in the way that we expect it to, and the way that's been agreed with the essentially the seller of the asset, or the incumbent asset owner that now has become our partner in these projects. And as Sachin mentioned, we spent a lot of time crafting agreements that protect the Reabold position, and we've done that to the best of our ability, and that's the thing that we continue to manage as we go through, as we take these projects through to fruition. Okay,
but you're not actually hands-on, so to what extent can I ask you what the workflow is on these different projects that you're involved in, and is that still a relevant question for you guys? What happens next in terms of workflow?
Well, so I mean, we deliberately have non-operated positions. That itself was a deliberate decision at the outset of this, and that's in part because another thing we've seen as investors looking at this space for a long time is that a number of junior companies get together to take an asset forward, and they replicate costs to an insane degree sometimes, because everybody has their own fully staffed technical teams all doing exactly the same work. Now, our model is to leverage off the expertise and the data that already exists within the incumbent asset owner, and to make sure that we can make use of that without having to put Reabold capital into replicate those same costs. So to that extent, it's true that we are hands off. However, the strategic part of management of these companies and management of these assets is something we spend a lot of time on, and we are very, very hands on in that regard.
Talking of which, I have two chief execs sat in front of me. Why did you decide to go for the two chief execs model?
Well, as we were just saying, and I think you've kind of led up the question to this point, we are doing things very differently in the industry that has many sort of modus operandi that might not be fit for the time that we're in from a capital markets point of view. So when you're challenging the norm and you're coming at things differently, it often requires two people to look each other in the eye and know that when they are challenging the norm, they're doing it both for the advantage of us as the management team and for the Reabold shareholders, and providing the protection we described. As we just said, we are crafting individual shareholder agreements. We are having our rights associated with the JOA, but not being on the JOA, and we're thinking about the way we exit and make investments very, very differently to the way an operating oil and gas company would. When you're challenging the norm so much, it does require two of you to be able to make sure you're executing it to the absolute best of your ability.
Sachin and Stephen, sadly we're out of time. Thank you very much for joining us today.
Thank you.
And as ever, thank you very much indeed for watching.